Hi, my name is Larry Donahue, and I've been an IP lawyer, business lawyer, and corporate lawyer for the past 30 years. I'm here to talk about briefly disregarded tax treatment. What the heck is it? It's a form of taxation for an LLC. Quickly, corporations have two types of tax possibilities. LLCs have four types, and they kind of map like this. So an LLC can be disregarded. It could be partnership. It could be S-Corp or C-Corp. Corporations, S-Corp or C-Corp. So that's kind of why I do this. And that's why I like LLCs. They're very flexible from a tax perspective. Now, what does that mean for you? Well, let's go back to disregarded. What is disregarded tax treatment? It basically means it doesn't exist from a tax perspective. The IRS doesn't care about it. It's, the analogy I use is a paper route. It's like having a paper route. So it doesn't mean you don't have to pay taxes. That's not what it means. What it means is the entity itself is disregarded. It's not nobody. It's like a sole proprietorship. It doesn't exist for tax purposes. So all the money you make, the expenses you occur flow to you personally, and you report that stuff in your Schedule C, your federal Schedule C. That's what disregarded tax treatment is. Now, it's actually kind of interesting. By the way, it only works for sole member LLCs or LLCs that are owned by a husband and wife team only in a community property state. That's the only types of owners in an entity that can have disregarded tax treatment. So why is that important? Well, probably for you, if you're just starting out, you're not making any money. You got 50 million other things to worry about aside from taxes. So disregarded is really convenient. It allows you to just not worry about the taxes as an entity, and instead any revenue, profits, and losses are just going to flow up to you personally. So it makes things nice and easy. So that's why disregarded tax treatment is really preferred for new entities, new structures. Now, what's really exciting, and this is the same with corporations, by the way, but you can change the tax status over time. Now, you can't do it just willy-nilly. The IRS has rules around it, and I am not a tax professional. This is something you do need to talk to your CPA or a tax lawyer about, like, what are the rules to changing? But you can do it. So what that means is over time, as your company starts getting bigger, there's going to be an opportunity where you may save money not being taxed as a disregarded entity anymore, and maybe like an S-Corp. So talk to a tax professional once you start making a little bit of money to see how you can save money and not pay Uncle Sam. But disregarded is a great way to sort of start out with a new corporate entity, and it's going to affect your operating agreement too.